If you're getting value from this analysis, make sure to like and subscribe to the stockanalytics.ai YouTube channel. And remember, members get priority deep dives on tickers. Stick around until the end because we'll reveal where our analysis suggests the stock could be valued compared to where it's trading today. Okay, let's unpack this. Today, we are doing a deep dive into Innoviz Technologies, ticker INVZ. This is a company that is really at the forefront of a technology absolutely crucial for the future of autonomous vehicles, LiDAR.
Right. And our mission for this deep dive is to take the stack of source material you've provided, articles, research, our own notes, and extract the most important nuggets. We want to help you quickly get informed on Innoviz's business model, their financials, the key risks, the potential upside. Really cut through the noise.
All right, let's dive deep.
Chapter 1, Business Understanding.
Okay, so fundamentally, what is Innoviz Technologies? What are they trying to do?
Well, they design and manufacture these high-performance, solid-state LiDAR sensors and the perception software that goes with them. You mentioned LiDAR, light detection, and ranging. Think of it like radar, but using laser light instead of radio waves. It builds this incredibly detailed, real-time 3D map of everything around the vehicle, much higher resolution than radar, which is critical for self-driving cars to navigate safely.
Sort of the eyes of the autonomous vehicle. Do they have specific products for this?
Absolutely. Their first big one was the Innoviz. Getting selected by BMW for that was a huge validation point,
Yeah.
a foundational step. But their current flagship is the Innoviz 2. It's meant to be smaller, more powerful, and importantly, lower cost. That's key for mass-market cars. It's the sensor that's part of their big deal with Volkswagen. And they're looking beyond cars, too, with Innoviz 360 and Innoviz Smart for things like robotics, traffic management, even security.
Okay, so sensors and software making 3D maps. How do they actually make money from this? Is it just selling the sensors?
Long-term, yes, the goal is selling millions of those physical units. That's the big prize. But right now, and this is critical, a huge chunk of their income is NRE, non-recurring engineering fees. Automakers basically pay them up front for all the custom integration work needed to get the LiDAR perfectly fitted and working within a specific car model. It's vital cash flow for Innoviz now, and it's essentially customer-funded R&D. Shows commitment to.
Right, customer-funded R&D, that makes sense in this stage. So what's the potential market size we're talking about? How big could this LiDAR thing get?
The total addressable market, or TAM, it's projected to be enormous. Sources are talking growth from maybe a couple of billion today to somewhere like $13 to $16 billion by the early 2030s. That's a HAGR, a growth rate of something like 15 to 21% per year.
Yeah.
That's a massive tailwind.
Okay, huge market. But where does Innoviz fit in right now? What's their current slice of the pie?
Based on recent data, maybe around 8.9% in 2024.
Yeah.
The leaders right now are mostly Chinese companies. Hesai has about a third of the market, Robosense around a quarter. But, and this is key context, they dominate because they supply the huge Chinese domestic auto market, which adopted LiDAR faster. Innoviz's strategy is different. They're focused on landing these massive, multi-year design wins with big global automakers like VW and BMW. A single win like that can be worth billions over the life of a car platform. So it's less about today's volume, more about locking in tomorrow's production contracts.
So it's a different game they're playing. What gives them an edge then? What's their competitive advantage, their economic moat?
Several things. First, their tech and IP. They've got over 200 patents on their solid-state MEMS-based LiDAR. MEMS means microelectromechanical systems, tiny mirrors steering the laser. More robust, more compact than older spinning designs. They also use a 905-nanometer laser, which sources suggest gives them a cost advantage over competitors using the more expensive 1550-nanometer type. That's crucial for mass adoption.
Okay, tech advantage. What else?
Probably the biggest moat is those design wins themselves. Once a car company spends years, millions, integrating your specific sensor, switching is incredibly painful. It means re-engineering, retesting, huge costs, huge delays. That integration creates really high switching costs, makes the relationship very sticky.
Right, they're locked in, essentially.
Exactly. And finally, they operate as a tier 1 supplier. They deal directly with the automaker, not through a middleman. That builds trust, cuts costs, strengthens the relationship. It all reinforces that moat. Chapter 2, Management Evaluation.
Okay, let's talk leadership. Who's steering the ship at Innoviz?
The CEO is Omer Keilaf, one of the co-founders. And what's quite interesting is the background of the founding team. Keilaf and several others came from a really elite tech unit in the Israeli Defense Forces, the IDF. That's not just, a fun fact. It suggests deep technical expertise, discipline, problem-solving under pressure, things automakers really value. Keilaf himself has over 20 years in electro-optics, computer vision, multiple degrees, deep background.
That IDF background is interesting. How has this team actually performed? What's their track record look like?
Well, they navigated taking the company public through a SPAC, which is always complex. More importantly, they landed those huge design wins, BMW, VW. That's massive validation. Now they're in the tough phase, transitioning from R&D startup to mass manufacture. That meant making hard calls, like workforce reductions to conserve cash. But that engineering discipline from their background probably helps with credibility and execution focus when dealing with the car giants.
A key point for investors is always capital allocation. Are they using the company's money wisely?
Well, standard metrics like ROIC, return on invested capital, are deeply negative, like NICSI 54%. But you'd expect that now. They're investing heavily before the big revenues arrive. So you look at strategy. It's survival and execution. They've cut costs. And that NRE payment plan is quite clever. They secured about $95 million in commitments from customers for 2025 through 2027. That's non-dilutive cash, meaning no new shares issued, and it's customer funded.
Yeah.
Shows commitment, like we said. They also did a stock offering early in 2025 to boost the balance sheet, extend the runway. Necessary, but yeah, it does dilute existing shareholders.
Which brings us to insider alignment. Are the executives invested alongside shareholders? Do they have skin in the game?
The CEO, Omer Keilaf, owns about 1.5%. That's worth a few $1,000,000. For a founder, that's pretty meaningful. His interests seem tied to the company's success and his compensation. Heavily weighted towards performance, over 74% from bonuses and stock. But, and the sources flagged this, looking at insider activity over the last year, there's been almost no open market buying, just one small sale recorded. While selling can happen for many reasons, insiders usually only buy on the open market if they think the stock's undervalued.
All right. So the lack of buying raises a question.
It's a potential yellow flag, yeah.
Yeah.
Why aren't insiders buying more if they believe it's cheap and the future's bright? Something investors notice. Chapter 3, Financial Health.
Okay, the numbers. Let's get into it. Is Innoviz profitable? Are they making money?
No, not yet. Simple answer. They're still deep in that investment phase, building out capacity, refining tech for mass production. When we look at margins, gross margins is revenue minus direct costs, operating margin subtracts R&D, sales, etc. Net margin is the bottom line. They're losing money. Reported a net loss of $12.6 million in Q1 2025, over a $100 million loss for the full year 2024.
But didn't they hit positive gross margin in Q1 2025, like 40%? That sounds like a good step.
It is a good step. Definitely a milestone, shows discipline. 40% gross margin is healthy. However, the context is vital here. That positive gross margin was driven almost entirely by that high-margin NRE service revenue.
Ah, the engineering fees again.
Exactly. The big question, the one that matters for long-term profitability, is can they keep positive gross margins when they're selling millions of physical LiDAR units at automotive price points? That hasn't been proven yet at scale. Good sign, yes. But hardware profitability is a real test.
Okay, so zooming out, how solid is the company financially? What's the balance sheet look like?
End of Q1 2025, they had about $85.4 million in cash and equivalents, liquidity. Their current ratio, current assets versus current liabilities, looks healthy. Over $108 million in assets against about $25 million in liabilities. They can pay their near-term bills. They also have very little debt relative to equity, low DE ratio. So debt isn't the main worry. The primary concern really is the cash burn rate. How fast are they spending that cash?
Right, the cash burn. Let's talk cash flow, free cash flow, FCF. Are they generating cash or just burning through it?
Burning through it right now. FCF is the cash left after paying operating costs and capital expenditures, basically cash in the wallet. In Q1 2025, they used about $18.8 million in cash, just from operations. That led to a negative FCF of around $20.7 million for the quarter. Management knows this. They talk about it. They're focused on reducing burn with cost controls and those NRE payments. But the whole story, the whole investment case, hinges on them reaching high-volume production profitably, flipping that cash burn into positive cash flow.
Okay, so unprofitable, burning cash. How does the market value this? PE is useless here. What about price to sales, PS?
Their forward PS ratio is around 5.5x. Now let's look at some peers. Luminar, LAZR is maybe 2.2x. Hesai, HSAI, is higher at about 8.5x. Ouster, OUST, similar to Innoviz at 5.1x. Septon, CPTN, lower at 2.9x. So Innoviz is sort of in the middle. The market seems to be balancing those big design wins against the current financials and the execution risk.
Not the cheapest, not the most expensive. Reflects the uncertainty.
Pretty much. They're not getting Hesai's volume premium, but they're valued above some others without those top-tier OEM contracts.
Okay, let's try an educational exercise. A discounted cash flow model, a DCF. Explain briefly how this works.
Sure. A DCF tries to estimate a company's value today based on all the cash flow it's expected to generate in the future, discounted back to present value because money tomorrow is worth less than money today.
And it relies heavily on assumptions, right?
Yeah.
Not a prediction.
Exactly. It's a model based purely on the inputs. Garbage in, garbage out, as they say. So for our exercise, we'll assume revenue growth starts with analyst estimates $55 million, $25, $129 million, $26, then slows down gradually over 10 years. For future profitability, we'll pencil in a mature free cash flow margin of 15%, reasonable for scaled tech hardware. The discount rate, or WACC, think of it as the cost of capital reflecting risk we calculated around 9.5% using their market sensitivity, beta 0.98, and current rates. And terminal value assuming 2.5% perpetual growth after year 10, sort of in line with the global economy.
Okay, plugging those specific assumptions into the model, what value range does it spit out?
With those assumptions, this particular model gives us an estimated intrinsic value range of roughly $2.20 to $2.80 per share. Chapter 4, Market Sentiment.
All right, let's shift gears. We've looked inside the company. Now let's look at how the market sees it. What's the feeling on Wall Street? Analyst views.
Generally positive among the analysts covering the stock. The consensus rating is mostly buy, or strong buy. Their average 12-month price targets are interesting, quite a range, from about $2.40 up to maybe $4.70.
So they see significant upside from where it is now.
On average, yes. Firms like Rosenblatt, West Park Capital, they've kept their buy ratings, pointing to the VW deal, the tech.
And what about the general chatter, news headlines, social media buzz?
It's very mixed and really driven by specific news. You get positive spikes on partnership news like VW NVIDIA, or that record Q1 revenue, or expanding into new markets. But then you get the negative headlines, hammering on the cash burn, the stock dilution from offerings, and that recent NASDAQ notice because the price dropped below $1.
It's a volatile sentiment.
Very. And on places like Reddit, you see passionate retail investors. They often love the tech, the potential, but they're clearly frustrated by the slow ramp up and the stock's performance.
Looking at the charts quickly, what are the technicals saying short term?
Well, as of mid-June 2025, the stock was trading just above its 50-day moving average, around 72 cents. That might suggest a bit of recent stabilization or bounce, but it's still well below the longer-term 200-day moving average, which is near $0.88.
And below the 200-day usually means?
Technical analysts usually see that as the longer-term trend still being bearish,
Right,
or down. We haven't seen a golden cross, the 50-day crossing above the 200-day, which would be a stronger bullish signal.
Got it. Now, short interest. This is always fascinating. How many people are betting against Innoviz?
It's high, very high. As of late May 2025, something like 23 million shares were sold short. And the days to cover how long it would take shorts to buy back all those shares based on average volume was around 7 days. That's quite significant.
7 days to cover. Wow. So what does that high short interest really mean?
It's a real double-edged sword. On one hand, it's a clear sign of strong market skepticism. A lot of money is betting the company will fail or run out of cash, that the price will fall. But it also creates this coiled spring effect. If Innoviz delivers a major positive surprise, a big new win, faster ramp, better cash flow,
The shorts have to buy back quickly.
exactly. They scramble to cover their positions, buying shares, which can force the price up rapidly. That's a short squeeze. So it's a major risk indicator, reflecting doubt, but also potential for explosive upside volatility. Chapter 5, Ownership Structure.
Who actually owns Innoviz stock? What's the breakdown?
It's quite spread out. The biggest chunk, surprisingly maybe, is the general public. Retail investors. Estimates put them at holding somewhere between 57% and maybe 69% of the shares. High retail interest. Then you have institutional investors, VCs, private equity, mutual funds, asset managers. They hold roughly 23% to 31%. Top names mentioned in sources include Heights Capital Management, Migdal Mutual Funds, Fifth Delta, Neuberger Berman. And finally, insiders, executives, board members hold around 2%.
And focusing on those insiders again, what about their recent trading activity? Buying or selling?
Well, as we touched on earlier, the past 12 months show almost nothing on the buy side. 0 open market insider buys reported. There was just one recorded sale, fairly small, 10,000 shares. And again, that lack of buying stands out. Selling can happen for lots of reasons, diversification, taxes, whatever. But insiders usually only put their own money into buying more stock on the open market if they truly think it's undervalued.
So that yellow flag persists.
Yes. It makes you ask, if the people who know the most aren't buying at these levels, why not? It's a fair question for investors to consider. Chapter 6, Risk Assessment.
Okay, let's try to summarize the key risks and strengths. A SWOT analysis might help frame this. Strengths, weaknesses, opportunities, threats.
Good idea. For strengths, you've got the cutting-edge tech, that solid IP portfolio with 200-plus patents, the huge design wins with VW and BMW, creating those high switching costs, and that experienced technical leadership with the IDF background, giving credibility.
Makes sense. Weaknesses.
The big ones are financial. Consistent losses, high cash burn. And then there's the execution risk, actually delivering millions of these complex units reliably and on time. That scale-up is tough, relies on partners like Fabrinet.
Opportunities seem clear.
Definitely. The massive growth in the LiDAR market itself is the biggest one, expanding beyond cars, robotics, smart cities, logistics. Plus, management is guiding for 1 to 3 new program wins this year, which would be huge catalysts.
And the threats. What could derail them?
Intense competition, especially from those Chinese players like Hesai and Robosens who have volume advantages. Macroeconomic issues, interest rates hurting car sales, inflation hitting costs, technology risk, what if someone comes up with something better or cheaper? And customer concentration relying heavily on a few big customers like VW is always a risk. Chapter 7. Conclusion.
All right, we've covered a lot of ground. After this deep dive, what's the synthesized bottom line? What should listeners take away?
You can really boil it down to a bull versus bear narrative. The bull case rests on that validated tech, the massive validation from the VW and BMW wins, the moat this creates, the Tier 1 status, and riding that huge wave of LiDAR market growth.
And the bear case?
The bear case highlights the fierce competition, especially from China. It points squarely at the financial reality, the losses, the cash burn, and the monumental execution risk of scaling production. The high short interest reflects this skepticism perfectly.
And we ran that educational DCF model, which, with its specific assumptions, suggested a value range of $2.20 to $2.80 per share. Important to remember that's assumption dependent.
Exactly. And compare that range to the current share price, around 92 cents as of mid-June 2025. It's trading well below that model's estimate. That gap tells you the market is pricing in a significant amount of risk. It sees the potential, sure, but it's deeply concerned about the near-term financial hurdles and whether they can actually execute on these big contracts.
So a final thought for our listeners to chew on.
The absolute critical story for Innoviz over the next, say, 2 years boils down to one word: execution. Can they successfully launch the programs with VW? Can they manage cash burn effectively and get towards positive free cash flow without needing way more funding? Can they turn that pipeline into more concrete wins and profitable growth? The answer to those questions, the execution questions, will determine if Innoviz truly becomes a key eye for the autonomous future, or if they stumble on the way.
Remember to like and subscribe to stockanalytics.ai. Members get priority deep dives.
And please remember, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.